Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 386 on August the 1st, 2025. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on Faraday Future Intelligent Electric Inc., SoundHound AI, and Kohl's Corporation. And we discuss three new trades on EOS Energy Enterprises, Applied Digital Corporation, and Rocket Companies. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show today, or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the market fell more than 2% this week. The Dow Jones Industrial Average lost 1,313 points, closing at 43,588 points. The S&P 500 index dropped 150 points, ending the week at 6,238 points. And now it's time for the topic of the week. The topic of the week is fear. There's so much that can be said about fear that I don't even know where to start. People typically don't make the best decisions out of fear. The fear of pain and loss typically lead to more pain and loss. When I was growing up, people used to say, scared money don't make none. Now, pardon the poor grammar for a moment, just acknowledge the meaning. And I found it to be true in trading as well. If I'm afraid of a market move or afraid to get in, I typically lose money. I either miss an opportunity that had the perfect setup, or I wait for the market to move enough for me to feel comfortable getting in, and that's typically about the end of the move, and I'll turn around and lose money. Now, don't get me wrong. Fear is not totally a bad thing either. Fear is a reminder of the possible risk in a situation. And if you're afraid to trade, analyze why. You might be trading a size that is too large for your account, or maybe you lack confidence in your trading style. That might be an indication to also trade smaller. The thing I've always loved about options is that it's simply mathematics. Always do the math. Always understand the risk. Then trade accordingly. Don't have fear. Meet that fear with an understanding of risk management. There are times when you should swing for the fences, but those opportunities don't happen on a daily basis. Fear can paralyze you and cause you to make bad decisions. I typically win by understanding risk, which means doing the math and adjusting my size accordingly. So that's it for the review of last week's trades. We're going to get into the review of this week's trades. And as a reminder, or as a foresight, if you will, keep in mind that the trades that I present here on this show typically benefit from markets moving higher. So when you have a week when prices go down, typically you're going to have a week where I'm losing money on the trade. So that being said, let's get into the review of last week's trades. We're going to start off with the covered call on Faraday Future Intelligent Electric Inc. That symbol F as in Foxtrot, F as in Foxtrot, A as in Alpha, I as in India. At the time, the stock was trading for $2.91 per share. I looked at buying stock and selling the August 3 call at 49 cents, hoping for a return of 19.93% in 3 weeks. Well, shares of Faraday fell 90 cents, ending the week at $2.01 per share. And that's a big drop for this stock. It has such a low stock price. Now, the call option we sold fell 37 cents, leaving us with a net loss of 53 cents if we were to close the trade out immediately. Now, we are well below our break-even point, and the stock has truly gotten away from us in this trade. You are definitely justified in closing this one out and walking away. Now, even if we roll the strike of the option lower, we won't offset much of the loss on the week. The only way I would stay in this trade is if I truly believe prices would head higher in the longer term beyond August expiration, because you'd end up holding the stock for a little bit. Otherwise, I'd likely exit this one. You can always choose to not make any move. And the beauty of using such a low price stock for these covered calls is that the maximum loss is already limited because the stock price is so low. So there's 2 weeks left until expiration to decide if I'm going to make any adjustments on this. Of course, if you are going to make some adjustments, you'll need to do so quickly because of the 2 weeks. All said on the covered call, it might be worth taking the loss and moving on, waiting for a new trade. Next up, we have the credit spread on SoundHound AI, symbol S as in Sierra, O as in Oscar, U as in Uniform, N as in November. At the time the stock was trading for $11.71 per share, I looked at selling the August 10 put spread at 20 cents. That could give us a maximum possible loss of 30 cents per spread. Now, shares of SoundHound fell $1.60, ending the week at $10.11 per share. The out-of-the-money put spread that we sold is now at the money. The stock price is below our short strike, which means this trade is losing money at the moment. Now, I'm leaning towards turning this credit spread into an iron condor by selling the 11.5-12 call spread at 10 cents. That would lower the maximum possible loss and create a profit range over the next 2 weeks. This also moves our total possible loss from 30 cents down to 20 cents, and it increases the possible win on the trade as well. We just need the stock to expire 40 cents higher in 2 weeks, and this trade will be a winner. Of course, with selling the call spread, we also need the stock to expire below $11.80 per share in order to avoid a loss on the trade. But at this point, it's certainly worth doing the math on making an adjustment, and I'm leaning towards turning this one into an iron condor. And finally, we have our debit spread from last week on Kohl's Corporation, symbol K as in Kilo, S as in Sierra, S as in Sierra. At the time, the stock was trading for $12.78 per share. I looked at buying the August 12.5 call spread for 31 cents. That could give us a maximum gain of 19 cents, or that would have been a 61.29% return in 3 weeks. Well, shares of Kohl fell $2.04, ending the week at $10.74 per share. The in-the-money call spread that we bought is now out of the money. The stock is nearly $1.60 below the break-even point, so we have some decisions to make. Now, before we start, I always like to remind myself that without any adjustments, the most I can lose on this trade is $31 in real terms. Now, I want to make sure that I keep that in mind as I make adjustments, because typically those adjustments will increase the maximum possible loss. The second reason I acknowledge the real amount of money that my maximum loss is because if I had simply bought the stock, I would have lost $204 this week on this trade. Now, yes, I hate losing any money at all, but option spreads at least give me a means of having less of a loss than simply trading the shares outright. Now, I might hold off a few days since the stock price is right on the 20-day moving average. The premium on the call spreads are so low that it's not very appealing to turn this long spread into a short spread by rolling the strikes. It would lead to an increased maximum possible loss, and you wouldn't collect enough premium to fully offset the money that you spent on the trade, meaning you'd sell the call spread, you'd flip the long spread into a short spread, but it wouldn't cover the money that you put into the trade, and it would increase your total loss. So for now, I'll look to give this stock a day or two to breathe. And if I did alter the call spread, I would pair it with a short put spread to create the iron condor. Just make sure the math works out and that you fully understand the total risk, like how your risk is going to change by making that sort of an adjustment. So that's it for the review of last week's trades. We are 2 weeks away from the August monthly expiration on August the 15th. All trades on today's show are a bit riskier due to the limited amount of time until expiration. Next week, we'll begin looking at option trades using September expiration. So let's go ahead and dive into our first trade on the week. It's going to be a covered call. I'm looking at EOS Energy Enterprises, symbol E as in Echo, O as in Oscar, S as in Sierra, E as in Echo. The stock ended the week at $5.51 per share. I'm looking at buying that stock and selling the August 6 call at 23 cents. That could give us a return of 13.07% in 2 weeks. Now you enter this trade by buying stock for $5.51 per share and selling the August 6 call at 23 cents. This trade makes the most money if stock prices finish above $6 per share. The break-even price is $5.28 per share. In real terms, the stock purchase will require $551 and you'll collect $23 for selling the option. Next up, we have a credit spread on Applied Digital Corporation, symbol A as in Alpha, P as in Papa, L as in Lima, D as in Delta. The stock ended the week at $12.52 per share. I'm looking at selling the August 12 put spread at 19 cents. That could give us a maximum possible loss of 31 cents per spread. Now you enter this trade by selling the August 12 put at 89 cents and concurrently buying the August 12 put for 70 cents. This is a credit spread because we're selling the spread, and this trade makes the most money if stock prices expire above $12.50 per share. The break-even price is $12.31 per share. In real terms, you'll receive $19 per spread you sell and have $31 at risk. And then our final trade on this week's show is going to be a debit spread on Rocket Companies, symbol R as in Romeo, K as in Kilo, T as in Tango. The stock ended the week at $16.52 per share. I'm looking at buying the August 16 half call spread for 33 cents. That could give us a maximum gain of 17 cents, or that's a 51.52% return in 2 weeks. Now you enter this trade by buying the August 16 call for $1.08 and concurrently selling the August 16 half call at 75 cents. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $16.50 per share. The break-even price on this trade is $16.33, and in real terms, you'll pay $33 to enter the spread, and your maximum gain is $17 per spread. So that's it for this week's show. Thank you guys for listening. Thank you for sharing as well. Hey, I want to send a shout out to my friend Keith down in Houston. He told me this week that he listens to me every week, and it made me, a little nervous. It's always interesting when my friends listen to it, especially those who have been professional traders. But I appreciate the listens, and thank you for all of you who are non-professional traders but still listen every week. So I love getting emails as well. You guys sent me some great emails last week. Keep them coming. It helps add a little extra fun to these slow summer trading times. Of course, I say it's slow, but these markets have been a bit volatile. So kudos to all of the news that's been coming out. So I'm just happy that volatility can work well for us option traders. So that's it for this week's show. Have a wonderful weekend, and as always, happy trading.
Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.